Welcome to another Stock Odds podcast. This is Odds and Ends with Dave Singh and Rob Friesen. Good evening, Rob. How's everything?
Good evening. Sorry we're running a little bit late there for our listeners. Busy weekend, but yeah, it's lots going on. So we had 8 weeks down on the Dow, and that hasn't happened since when, Dave?
Since 1923. So once in a century we get a streak that
now I wasn't alive back then, so I don't really know what happened. But the 2001 7 weeks down on the SPY, or the S&P 500 index, that one I was there for. So I started trading in 1998 professionally, 1992 retail. So that one I was in the middle of, and it was very, very interesting to have created that. Not that I created it, but the bubble was created in 2000, and we started to come down the backside of that. And so we had some really crazy times in 2000, 2001, and even into 2002 a bit before it sort of stabilized. And we saw a tremendous amount of mean reversion, like some of these pairs, great relationships, in multiple industries, multiple sectors, they just came together after being very, very distorted. So that's what bubbles do a lot of times, is they distort things. You could have one company, has a PE of 200 and the other company has a PE of 30. And you got to argue, well, why does one have one of 200 or 300 and the other one, does the same thing? It's so little. And it's those kind of things coming back together that happen when market regimes change. And we've really seen that this year so far with all the things going on. So we're in a big macro environment. One of the headlines I saw on Bloomberg was, the markets are crazier than they've ever been, right? Nobody has a clue, basically, right? And yet we're seeing some pretty good, metronome type returns from StockOdds. So what's beautiful about StockOdds is that it says, here's all the performances that have happened and the different indicators and the subsequent behavior after, you get an RSI that's discounted or at a premium, or you get, a standard deviation move, or you get, a momentum or Connors or, stochastics or percent R, CCI, whatever your favorite stuff is. You get the subsequent behavior after the signal has lit up, and that's really helping us, make sense of things, is to drill into the data and to pull out these things, and to give ourselves a little bit smoother performance. We've lined up a few ducks, meaning we just don't curate only from RSI. We like to curate from a number of the indicators and see which symbols match. So that gives us a little bit more durability in the trade and sort of lowers the variance. Isn't that what you found too, Dave?
No, totally. Because even the one signal might be in favor for a period of time, then reverse. So RSI might be good for 2 weeks and then not good for another 3 weeks, right? So having a good mix of 5 to 10 to pull from, right, it doesn't mute out the performance. So
we're coming into the last week and a bit here of May. There's still, there's a lot of things on the horizon still. There's some earnings. I mean, we're through the bulk of the earnings season, but there's still some. So keep your eyes on that. We move into more dividends later in May and June. Then we've got the Russell rebalancing, near the end of June there. So institutions are already kind of figuring out which symbols are being added or subtracted from the Russell 1000, 2000, and 3000. And, it takes a little bit of hunting around. They will start publishing at the beginning of June what the preliminary lists are for the rebalancing. But, we're in that time before the summer July earnings season, and, lots of transition can happen between June and July. So I'm leaning more towards that we're not out of the woods. We've got another, rate hike coming in June, another 50 basis points. So that's already, agreed upon. It's not a surprise, but we have to see, how the market likes that, accepts that, reacts off that. But I'm still leaning more towards the chance of a summer rally, and I'm not really expecting too much of a bounce before that.
Mhm.
And I could be wrong about the summer rally too. It might be Nothingsville, but it wouldn't surprise me if it catches everybody a bit
Do you mean from like
flat-footed.
June 1st on, or something more like in July?
No, I mean, I'm talking about more July when the earnings, because like what'll happen is based on some of these other earnings that we've seen, like Target, Walmart, all this stuff like that. I would think people would be expecting, the worst maybe. And then if you start to get some, good earnings, banks and brokers kind of lead the charge. That can set the tone if they're, performing well. We might kick into a rally, and it's happened before, when nobody expected it. So I'm keeping that on my list. But back to the seasonality, that starts on Tuesday, and the problem with this particular month-end seasonality, it's split by the long weekend. And so the last trading day of the month is on Tuesday, but you have the holiday Monday. So just keep that in mind. It can interfere a little bit with it. But Dave's put together some stuff here to talk about for the last 5 days. Why don't you get into that?
Yeah, I did some work earlier this evening. The last 5 days of the month, the SPDR is expected to do 0.25% return. But of that, the last 3 days are actually down minus 0.15%. And the last day itself is expected to be minus 0.45%. So what that's indicating is that return for the final 5 days is kind of weighted towards the front 2 days of that 5-day window. So in this case, it would be this Tuesday and Wednesday might be all the bang in those 2 days, and then kind of weaker the rest of the days. And within that, I look to see which sectors in ETFs would be stronger than the SPDR or weaker than the SPDR based on StockOdds data. And for things to be longer are real estate, the chips, the SOX, SMH, utilities, biotech, QQQ, XLK, small caps, IWM, diamonds, materials, financials, industrials, healthcare, and discretionary, and even ARK-K. And things to be shorter are actually oil, USO, XOP, and XLE, gold, GLD, GDX, GDXJ, silver, and XLC and XLP. So it's a bit of a risk on with the sectors there. Some of the defensive ones like XLP are weaker. So you have that kind of undertone there to expect in this last 5-day window. So and we're seeing a bit of that right now, right? The Nasdaq's up, strongest of the three compared to the Dow and the S&P 500.
Well, and coming off this, major discount
exactly.
of, 8 weeks with the Dow and 7 weeks with a SPY. People are going, well, I've missed the comeback tour before. I've missed these opportunities. This time around, I don't want to miss it. And so I would expect we could have a bit of a relief, Monday, Tuesday, Wednesday, even maybe possibly Thursday. Then Friday, you've got the problem of, thinking about the long weekend, maybe some risk. And once you're finished here, I'll bring out something that's in the possible works here to impact us here a little bit more. But why don't you finish up there?
Yeah, and like you're saying, coming from a discounted position. Like over the last 3 months, technology is down 16.9%, and over the last month, it's down 12.2%. So tech is discounted so much, especially the chips, that a rebound rally is likely, and especially with the stats here in the almanac. But yeah, other than that, I mean, we're still year to date down quite a bit on the Qs, 27%, on the diamonds, 14% down, spider 17%. So we are pretty sold off, but we don't know. It could be either way.
Well, definitely. So one of the things that's, a possible concern is, so you can look it up yourself, read about what's going on, but the Israel's conducting the Chariots of Fire, which is all segments of its IDF, military, Navy, everything, and so they're rehearsing for a potential attack on Iran. The reason is the intelligence says that Iran is installing 1,000 centrifuges, and that's to enrich uranium. So they're really close to, producing enough high-grade uranium to make a good-size bomb, which would be possible within a few weeks, actually, for at least a small quantity. But what I've heard is that Israel looks at it as an opportunity to deal with it now, versus if you don't take this opportunity, then it might be too late in 2 or 3, 4 months. So we're kind of at the door of that. It may never happen. I don't know. But if it does, it might impact some of the groups that you were talking about, Dave. So we're expecting oil to be a bit weaker in the last 3 or 4, 1, 2, 3 days of the month, maybe. Mm-hmm. Right? Maybe not so much right away, but maybe towards the end of the month they're supposed to be weaker. But if we get something else happening, it could change that. Same thing with gold. There might be a bit of flight to safety that way too. It's not as strong as it used to be. It's usually money. You can see money going into the U.S. dollar as a safe haven. But there's also the China implication of, like, we see when they're locking down things more that oil tends to suffer, and when they're opening it up, oil tends to rally. So, and it's still all in pretty good flux there. There's three major cities kind of locked down, but there's 47 other big cities that aren't. So anyway, just keep your eye on that. And, like, they have a small amount of cases. It's not like they have tons and tons of cases, but they just have this policy of zero COVID, right?
Yeah.
So the curbs are definitely impacting things. And there's about 180 companies that are directly impacted by these lockdowns. You've heard the Tesla one, and now the workers in the factory there have to, and this is happening with many factories, is that they live there, they don't go home in between. It's called a closed loop, right? Yeah. So you have to eat, sleep, and breathe factory in order to keep your job and produce. So it's definitely, an interesting macro environment globally, and we have to work with what we got. So coming in the morning, you could have your lists already prepared to go. And I was mentioning to Dave earlier when we were just chatting a little bit before, one of the issues that I find is if I have a very defensive list, because it looks like we have a risk-off environment, sentiment is pretty bad, maybe the futures are down a little bit, I could have a risk-off list, and some of those value stocks and those defensive stocks actually open up. So in order to get them on, you're paying up when the market's actually opening down. And the problem with that is when those stocks start sliding and filling the gap, before you even had a chance for the day, you're already underwater a little bit. So this is a little bit of a tension. So I would recommend that you be looking at your symbols and see how much they are indicated to open, if there's any trades on ARCA prior to the open, but are they indicated to open up a lot? Because on a down open and you're paying, 1 or 1.5 or 2% up, it could end up, causing you to have a worse day than you might like. You can still hedge, but you're already like, kind of fighting that pullback. There is one option, and that is if you see that, then hold off and don't take the opening print, make it a watch list and say, as I get some discount to these things, then I'm going to become interested. At the same time, if you had a risk on list and you saw that the market opened down and now some of the technology stocks are starting to get traction, like they really want to rally back, you could start grabbing some of those. Or you could split the list and say, I've got some risk on and I've got some defensive. I'm, going to be careful about paying up too much on the defensive, but some of these ones that look like they're opening flat, I'll take those. I'll take some of these discounted tech stocks, and then I've got a better blend. We always see with basket trading that if you are too much on one theme, it can end up, being a problem. It can really work, or it might backfire. And so what is thematic? Well, one theme would be you only have growth stocks. You only have high volatility, more speculative, really great growth opportunities, but nonetheless, they're not considered value stocks, right? So that's a theme. You're all in growth. Another theme would be you're all in value. You're in really defensive, low beta, kind of like, yes, they have earnings, yes, they have dividends, but you're just value. Another theme what might be that, you are really concentrated in oil, and that you could have a day when oil does amazing, or you could have a day when oil pulls back a lot. So it's always about this exposure. And when in doubt, try to pick only a few items from each group and be more diversified. And if it's an okay day, you'll still do probably pretty well, maybe not as good as the NASDAQ 100, or good as the SPY would do because it's still fairly tech weighted. You may not do as good as that, but you're going to still make money without hedging. Now, if it's a pullback type of day, that list still is recommended to be hedged, even though it might qualify for having some alpha over the market if the market pulls back. Like if the market pulls back 2%, your portfolio might only pull back 1%, so you have alpha over the market. But by hedging, you're going to cut your losses so you don't lose 1%. Most often you are more insulated. So I hope that helps. But just be careful of how thematic you are accidentally, as well as how thematic you are on purpose. And with that, you have to accept the risk that you're taking, because it may work really well and it may not. Sound good?
Yeah, good advice.
Well, it's curating the symbols that you want to trade is one part of it, and you might have some great ones. And even, using StockOdds, you can approach it so many different ways. So it's your imagination, your knowledge, all can be utilized. But then there's the execution part and what the market's doing the next morning. So if you want to be production-based every day, you've got to factor in, is the market gapping up? Is it gapping down? And the approach is going to be different. So like the best thing that could have happened to us for tomorrow morning would have been like, well, we had 8 weeks down in a row. The world is ending and the sentiment is horrible. Like you can't find a bull anywhere. And we gap down. Maybe the Dow's down 500, 600 points. And then you see the plunge protection team or the buyers come roaring in. Okay. You know, it's those type of days that can be just spectacular. But it's the problem is when you kind of open more flattish and then you start like, you know, just chopping around and then slowly drifting down and you have an orderly sell-off, but it's like, it's not capitulation either. Does that make sense?
Yep.
It's just an orderly sell-off. So let's look at what the futures are doing right now before we sign off here. The Dow Jones futures are up 163 points right now, 0.52%. When we opened at 6 p.m. Eastern time, we shot up right away, and then we've just kind of been kind of sideways trying to hang on to that gain. The S&P 500 is up 0.71%, so a little bit more percentage-wise, 27.75 points. NASDAQ is up almost a full 1% at 0.91, up 107.50. So as Dave said earlier, it is doing the best. Russell is up 0.74, up 13 points. The VIX is at 29.05. We did have a spike on Friday up into the 31.75 roughly. So over 30. Dave, you mentioned that a lot of talking heads that you see are, you know, saying, "Hey, we need a VIX of 40 to see capitulation."
But I don't know. So many are saying the same thing.
But I don't know. I don't know what. I don't know that does it, and I don't know what the bottom looks like. Like we're not going to know the bottom for sure. The point is, normally you get a big capitulation event that kind of sets a bottom, right? And so, yeah, I mean, I think one discouragement for investors right now is like when you have one day up and one day down, and then some people called for a bottom a week ago, and that turned out not to be. And so they get a little bit discouraged, and people tend to hold back. And if they're not willing to put money to work, then, you know, you don't have that buy side support. And you might, in fact, still have sellers out there, which drives it down even further. So it wouldn't surprise me to have another down week, being that we're going into a long weekend. People might want to, you know, even cut back a little bit more. We are in May. You know, you've heard of sell in May and go away. We are in May. So it's not generally one of the most bullish months of the year anyway. And we've got still a lot of risk factors out there. So, you know, my call is, you know, hey, if there's a bounce and people want to participate, take it. But I wouldn't be surprised if the hot money come out for the day comes back out near the end a little bit. And it also doesn't surprise me like we had on Friday. We were down and then we had a bit of a short covering rally right at the end of the day in the last 30 minutes of the day. That doesn't surprise me either. You have to be prepared for that. When you have a down session and it's kind of a chugging away, you know, last bit of the day, don't be surprised about a short covering rally, in the sense that people, you say, okay, well, I made some money here on the short side. And you can tell that a lot of people are pressing the short side when you look at the volumes in SQQQ, which is the long inverse, or in SDS, which is the SPY long inverse 2 times, right? You can see the volumes that are in those. So there's people using it just to trade directionally on the short side, but they end up, they don't want to take it overnight. So some of that comes back out. Anyway, hope this yakking has helped you guys. Thanks, Dave, for your time, and have a good day and a good week, okay?
All right, good luck. Thanks.